You're watching BCTV. We're all about Branford. You're watching BCTV, Branford Government Television, a service of Branford Community Television. This program is brought to you in part through the support of the town of Branford.
Keep her and not fill that up. You're right, not fill that up. Vacancy. I think that's a good question.
Is it going to be next year, or is that the reason it fits this year, but it's going to add it again? Well, they're going to have to put it in the budget.
Yeah. I don't think they're going to add this to the budget next year. Yeah, that's still there. It's just that
It's vacant.
the season part-time is the one that's being reduced. And that'll stay with you.
Oh, I see.
I guess we're
Okay. In other words, they're cutting down this.
Yeah,
this
cut
one here.
down.
Yeah, okay.
Okay, we're going to get started for Board of Finance meeting, Town of Branford, regular meeting, February 25th, 2019. First on the agenda is to approve minutes of the January 28th, 2018 meeting.
I read them, Joe. I think they're fine.
Second.
I'll move it.
Moved by Charlie, seconded, discussion. All in favor?
Aye.
Next is category citizens communications. If there's anyone from the audience who'd like to comment on tonight's agenda items, you're welcome. With no takers, we'll go to item number 3, which is to hear a presentation from GYL Financial Synergies and Hightower Advisors with regard to the performance of the town's police pension plan for the quarter ended December 31st, 2018, and if necessary, rebalance the portfolio. We'll also hear item number 4 and 5, which is the same wording to hear from these folks with regards to the volunteer fire incentive, and then for the other post-employment benefits trust. So, welcome, gentlemen.
Thank you.
Thank you all for having us here tonight. As we normally do, I'll provide commentary about the recent market events and environment and the economy overall. Michael and Luke will go through the performance and experience of the 3 different portfolios that we'll review tonight.
Thanks.
When we last met in November, it was quite an interesting time in the market environment. We were in the midst of a very severe market decline. During the fourth quarter of 2018, during that fourth quarter, the stock markets globally declined significantly. And when you look at that in the drawdown period, the U.S. stock market as measured by the S&P 500 during that decline from September 20th down to the bottom that was put in place on December 24th was a decline of over 19% during that period. Since then, we've seen a much different environment. Since the December 24th events, and the markets have advanced sharply from there where we sit today. One of the key contributors was the policy from the Federal Reserve. The Federal Reserve did raise interest rates in the middle of December, as was expected, but they changed their messaging and tone to be what we refer to as on pause, where they decided that they're not going to be raising rates again in the near future, and the markets are pricing in no change in federal funds rate policy over the next 6, 9, 12 months. That, along with progress with the trade war issues with China, have really led to a stock market rally that we've seen over the last 8, 9 weeks, where we've seen just in the 2019 period, U.S. stock markets up over 12% just for 2019. So it's been quite an interesting period of volatility, and that comes with its stresses and challenges, and that's why we take a long-term perspective and view to the environment and the economies so that we don't get whipsawed because of a short-term piece of volatility. And that was one of the sharper declines we have seen in quite some time. When you look at that and you realize a 20% decline in the stock market is very severe and very painful, but in turn the market has recovered substantially since then. And when I talk about that in the context of the U.S. stock market, I'm referring to large U.S. companies, but a similar decline was had in mid and small U.S. companies, even a little bit more severe, as well as in the international markets. Oddly enough, the emerging markets were the part of the global marketplace that declined the least in the fourth quarter. So that's what provided a little bit of downside protection in Q4. And those markets have advanced well over the last 8-9 weeks as well. So it's been quite a challenge in that regard. However, corporate earnings have continued to come in well. Growth prospects for the U.S. economy continue to look very promising, albeit slower than they have been in the last 12 to 24 months. But we're still looking at a GDP growth rate forecasted to be over 2% in the year ahead, 2.5% in the year ahead, which is still a very good, reasonable growth rate, with inflation hanging around the federal funds target, the Federal Reserve Board's target rate of 2% on inflation. So we're seeing very good indicators there. And unemployment is holding well below the 4% mark, which again is another positive for the Federal Reserve to stand on a flat policy at this point. The Europeans continue to struggle with stimulating the economies, and they continue to have negative and 0% interest rate policies there that the U.S. markets are since behind. So that continues to be a headwind in the European economies. Overall, we see reasonable growth, and we've seen the commodity price volatility stabilize, if not improve, which is another sign for health for U.S. corporations. And as far as commentary, just broadly on the fixed income markets, the yield curve, which is the difference of the interest rates from overnight lending out to 30 years, that relationship has continued to flatten substantially. And there's been the short part of the curve between 1 year and 5 years has had what they refer to as inversion, where the 5-year rate is slightly below the 1-year rate. And by slightly, I mean we're talking about 1 or 2 basis points, 3 basis points. The relationship that's commonly viewed in the media and by the market pundits as important is the relationship between the 2-year and the 10-year Treasury, and that still remains with a slight positive slope, granted very slight at 15 or 16 basis points. To give you a reference point, a year ago that was over 60 basis points. So that relationship between those bonds has come down substantially. So the 2-year Treasury is at 2.5%, with the 10-year Treasury at 2.66. That's what I mean by 16 basis points and how flat that's become. So that starts to give us just reason to, in the fixed income markets, to be on the more conservative side, which is aligned with the policy we have in place for Branford. With that, I'm going to let Michael talk about the experience of the fund, and then we'll talk about any adjustments that need to happen within the portfolios.
Okay, great. Thank you, Rob. So if everyone will please, in their book, turn to tab 1, page 16. We'll take a look at the performance. Of course, the fourth quarter and in 2018 in general proved to be a challenging year for the capital markets. Really, until December, virtually every asset class other than cash had a negative return, and then we saw a bit of a rally in fixed income at the end of the year, and fixed income eked out a positive return, albeit a slight one, for the year. The plan ended the year at $22.665 million. Return for the quarter was minus 7%, a little bit ahead of the benchmark, which was minus 7.2%. For the 1 year, the police pension was down 5.82%, and the majority of that, of course, coming from the equities. The equity fund was down 10% for the year. The fixed income, as I mentioned, slightly positive, up 15 basis points versus the benchmark, which was essentially unchanged, or up 1 basis point, owing to a little bit of outperformance, owing to the conservative nature of the fixed income portfolio and the credit restrictions on such. However, Mesro, your fixed income manager, has an underweight position or an overweight position to corporate bonds and an underweight position to treasuries. So they still had a little bit of headwind towards the end of the year when the treasuries really rallied, but relative to the benchmark, the credit quality restrictions served the plan well in 2018. I'd like to kind of give you a little color as to where we stand today. in light of the severe downturn we saw in the market and then the recovery we've seen that really began essentially the second trading day of the year. So if you turn to page 20, I want to focus in on a couple of numbers that we don't normally look at, but I think are worth having a look at. Most quarters we talk about the volatility of the portfolio and the relative lack of variability and volatility that we've seen. The beta of the portfolio continues to be about 9% less than that of its benchmark, while the long-term returns have been consistent with and slightly ahead of the benchmark. So that translates to a positive alpha you see of 4 basis points. But what I want to focus in on is in the summary of cash flows. And if you look at the one-year number, you can see the beginning market value at the beginning of 2018 was $23,631,000. Ignore the contributions and withdrawals, as that includes movement of money amongst the accounts, but focus in on the net cash flow of $440,000, and then the net investment loss for the year was $1,406,000. Since the first of the year, the plan has really recovered all of that and then some. The market appreciation, net of contributions and withdrawals, has been $1.636 million, and the value of the portfolio as of last night was just over $24 million at $24,025,000. And so if you look at the graph on the top left of page 20, you'll see the 24 million is right at the peak. So we're basically right about at the all-time high. We may not be quite there, but we're essentially there. And so what that means is that the market has essentially recovered all that it lost in 2018, and particularly in the fourth quarter of 2018. As far as the asset allocation is concerned, you are reasonably close to policy, a bit overweight in fixed income. However, cash has been depleted for benefit payments, and so we do need to raise some cash. So as we do every quarter, we get together and discuss this and review it with the finance director. And the recommendation for this quarter is to rebalance the portfolio and actually put a little bit extra in cash, go above the 2.5% policy. We go to about 2.8% in cash, or with a target balance of $700,000. The rationale behind that is, one, we've had a nice recovery in the market and we need to raise some funds for benefit payments, so the timing of it I think looks attractive. And then ultimately we're talking about raising enough cash to get us through the July benefit payments, which is the time at which the annual contribution is typically made. So we'll have another cash inflow coming in July, and we'll use that to rebalance. But this will set aside cash to make benefit payments until that time.
Okay, so that's you got 2 caches in here, but it's the one on the bottom.
That's the one on the bottom, yes.
The one that you're moving to 700,000.
Exactly.
And reallocation based on that.
Correct. The cash on top is just some
Right.
residual cash in the equity account.
Gotcha.
Accumulated dividends within the equity portfolio.
That's fine. Jim, you're in concurrence with this? So somebody want to make a motion that we rebalance per the recommendation of the advisors?
So move that.
Moved by Victor, seconded by Robert. Discussion? Questions? All in favor?
Aye.
Thanks.
So moving on to tab 2, we can look at the OPEB, page 16. Again, similar story, of course, to that of the pension. The value at the end of the year was $15,787,000. The return for the quarter was minus 7.5%, and the return for the 1 year at minus 5.25%. Also, of course, owing to the double-digit negative returns in most equity asset classes, really with the exception of real estate in virtually all equity asset classes. Since the end of the quarter, of course, we've had some nice appreciation as well. The value as of last night stands at $16,960,000. And so again, much like the Much like the pension, and you can see this on page 20, we've recovered the loss in the market in 2018. In 2018, under the one-year column at the bottom of page 20, you'll see the market loss for net investment change for the year was just under $880,000, and we've seen earnings of $1.17 million since the end of the year. So actually, that brings us up to a new high, and you can see that from the graph because we've eclipsed the $16 million mark. As far as the asset allocation is concerned, that this portfolio was rebalanced late last year, so you're really right on target with your target asset allocation. Since there are no regular outflows from this portfolio, there's no reason to shore up any cash, so there's no recommendation to rebalance the OPEB at this point.
Okay, thanks. Any questions on this trust fund? All set.
And then lastly, just to touch on the same figures for the fire pension, which is in tab 3, page 16. Again, a similar story, but of course much smaller numbers with the volunteer fire plan. Value at the end of the year was $1,020,000. This plan was down 6.9% for the quarter, 5.9% for the trailing 1 year. This, of course, is really passively invested across the board, including in the fixed income, owing to the relative size of the fixed income mandate, just $392,000. And if we turn forward to page 20, to give you a snapshot as of the close yesterday, or the close Friday, should I say. You can see, again, the one-year number at the bottom of page 20. In 2018, there was just over $64,000 in negative net investment change or in investment losses. And as of now, the value of the portfolio is at $1,086,000. That represents a $71,000 gain since the first of the year. So again, much like the others, the negative returns from 2018, at this point, the market has recovered and erased those from the value, and brings us to $1,086,000 as the ending market value. Much like the OPEB, you're well within the target policy parameters, and there's sufficient cash for current needs, so there's no recommendation to rebalance the fire pension at this juncture.
Okay, thanks, Michael. Questions on this? This are all set. Okay. Thank you for your presentation.
Thank you.
Next is item number 6 to, I'm sorry, yes, number 6 is to consider and if appropriate approve a request from the Director of Human Services for the following fiscal 19 budget transfer and corresponding resolution from undesignated fund balance 37,775 into regular wages and salaries 37,775. And Peter, welcome.
Good evening. At the last RTM meeting last year, my wages and salaries account was reduced by the $37,775, and what I'm looking to get it replaced back to our the undesignated fund or the special revenue fund.
So this is out of its own fund. This is not.
Right.
And so tell us why it's important to.
Well, because it came out of the wages and salaries, and I would have to eliminate a position. If I eliminated a position, I would have had some problems with covering the amount of people that are coming into the center. So to avoid that from happening, I'd like to have that replaced back.
So this represents a one person or a portion of an FTE?
Portion of an FTE.
Joe?
Yeah, I think I could probably help put some of this in context. Last year, when the RTM adopted the budget, they had proposed a reduction in the the Human Services Fund, Peter's separate special revenue fund. One of the reasons that they wanted to do that was that they wanted to lower the transfer in from the operating budget, and they wanted him to use some of the fund balance. On the floor of the RTM, that ended up being a lengthy discussion. I explained at that time that the RTM doesn't deal with revenues, so that there was no way that the RTM could basically, create his department using money from fund balance. And so that the only way to keep the funds in balance and to use less taxpayer money was to actually cut the budget.
Gotcha.
And so the budget was cut by the 3775, and then I pressed at the meeting further. I said, well, you have to cut it from someplace because that budget's part of our adopted line item budgets in the back of the budget book. They took a brief recess, and they hit the wage account, which was the largest single account. Because of that, that became problematic for Peter because now he doesn't have a position that he was able to fund, and so we discussed it among ourselves and said the way to actually remedy this is to actually take it back out of fund balance, which is sort of what was being pushed anyway, and that way he would be able to, fulfill what he originally requested, and then going into a future year, like say next year's budget, you wouldn't see this big jump in the salary account, and he'd be able to hire the person.
So what's the fund balance?
The fund balance as of 2018, it was 313,176, and then it would drop by, 37,775.
Gotcha. So while we have you here, Peter, revenues are doing well?
Revenues are doing well. I looked at it today, and I think we're about $50,000 short, and we should be able to hit that before the end of the fiscal year.
Questions from Peter? Charlie?
I'm trying to think back, Peter, but wasn't there something about the Yale doctors or fellows
Yep.
that you cut back on, or you didn't get the grant or something? What was that about again?
We cut back, well, what we requested from Yale was to have 2 fellows come in, but only give them $15,000 instead of $30,000. That's what they normally would want. And they agreed to do that for last year. So this year is coming up. I guess we haven't talked yet, Yale and I, but I think we're going to have to talk and see if they can do the same thing this year. Give us the 2 fellows for the same price.
Are these fellows doctors? Or
Yes,
not?
they are.
Oh, they are doctors?
They are doctors.
Oh,
They're
I mean, they're
prescribers.
MDs.
Yes.
Okay.
They're prescribers. They prescribe for the different kids that they see, adolescents that they see too.
Okay, now you have 2 of them now?
We have 2.
Okay, you hope to keep those 2?
Well, they change. Every year we get 2 new ones. It's a teaching experience for them. What we like about having them in is that they come with a lot of new ideas because they're learning. They're at the Yale Child Study Center anyway, and they do bring in a lot of ideas and a lot of studies that they've been working on. So it kind of helps us. It helps the staff because we're learning on some of the things that they're working on, and plus it helps the clients that are there that they're working with.
Peter, I'm sorry, Charlie.
No, I'm done.
Peter, what position would we be funding?
A clinical position, clinician.
Clinician. Okay. Mr. Chairman, I have no problem. I'll move this.
Okay, so I'll read the resolution. Resolved that the Board of Finance recommends to the RTM an increase in the appropriation for the fiscal year 2019 Human Services Fund budget from $1,480,657 to $1,518,432. The increase will be funded through an appropriation from fund balance. Robert, you're moving that?
Yes.
I'll second it.
Seconded by Jeff. Discussion? All in favor?
Aye.
Okay.
Thank you.
Take care, Peter. Next is to consider and if appropriate, approve a request from the Parks and Rec Department for the following budget transfer for fiscal 19 from contingency 22,000 into accumulated sick 22,176. Alex? How are you?
Good evening, gentlemen. This transfer represents a retirement payout for sick time per union contract of 120 days. This is for one of our longtime maintainers, Russ Burrows, who served the Parks and Rec Department with admirably for 32 years, 2 months, 2 weeks exactly, and his last day will be this Friday, March 1st. I will let you know that in the current contract, in this current union contract, they are able to accrue up to 120 days, but when any of the employees do leave at this point, there is no payout. So there's one of the longtime members that was in the union since 1986.
Okay. And you don't have funds within your own budget?
No, not for this line item.
Not for this line?
At this, no.
Okay. Questions?
I'll move it, Joe.
Moved by Jeff,
I'll second it.
seconded by Victor. Questions? All in favor? Aye.
Thank you.
Okay, got off easy tonight. Okay, we're going to move on to number 9 and 10 and come back to 8 after that. If that's all right with you, Jamie? So, number 9, to consider and if appropriate, approve a 2-year contract extension for the diversion of municipal solid waste with Covanta Bristol in their Preston facility at the cost of $56.50 per ton for fiscal 2020 and for $59.33 for fiscal 21. Dan, how are you?
I'm well. How are you?
Good, thanks.
Good evening, everyone. So this is a diversion we've been doing for the last number of years. Our main contract is to deliver our waste to the Bristol facility, but we have this mutual diversion to send it to their Preston facility at a lower tip fee. So between that and the hauling, it's about a savings of $7 a ton. For the amount of tonnage that we create here in town, it's nearly a 6-figure savings.
Okay. Good job. Questions from Dan on this?
I'll move it.
Moved by Bob,
Second.
second by Victor. Questions from Dan? All in favor?
Aye.
Aye. You got that one, Dan. Next is to consider and if appropriate, approve amendment to the contract for commingled containers with Murphy Road Recycling LLC. This amendment is for 3 years with 2 one-year extensions. And do you want to go over this with us?
Sure. So this is the same term as the original amendment, or the original contract for the recycling of our bottles and cans, the commingled container mix. It's the plastics and aluminum and glass that we put out at the curbside. That contract is just to recycle those materials, so whenever paper or cardboard or anything like that gets mixed in, recyclable material that we keep in a separate stream, when those streams get mixed together, it becomes a single stream, mixed recycling. The contract doesn't account for that. So when those situations occur, it's charged at a rate of $95 a ton to dispose of. This is an attempt to get a price point in the contract for when that does happen and set that at $75, which is the current market rate to get rid of what is considered single stream recycling.
So this is for everything?
This is yeah. So when the bottles and cans mix, that stream that we separate gets mixed with the the newspaper and the cardboard streams that we keep separate. In the inadversion that those get mixed together, it's so we have an option to get rid of it at a lower cost than what we currently. When that happens, it's considered contamination, and we get billed at a rate of $95. This would set a price point in the contract when that happens at $75 a ton.
And how often does that happen?
Not that often. More often lately, there's been more mechanical failures with the hauler, which is the reason typically that it happens. But it, 20% of the time.
So is there recourse back to the hauler, or is?
There is when the hauler, and when it happens, when the hauler has an accident or collects, there's a fining mechanism to collect off that contract.
So it's not necessarily at the pickup, it's actually at the handling of it?
It's usually in the pickup or when the compartment, the multi-compartment truck dumps, that the stream will mix in with the door that keeps those compartments separate fails. That happens.
Jamie, any comment on this?
Well, I just also think it's important to note that this is where we need to be diligent in when we segregate our recycling, because a lot of it is happening at the collection point itself. Branford is one of the probably few communities that still does a multi-stream recycling program, which with the current crisis that's happening in the recycling industry, although we've been hit, we haven't been hit as other towns. However, this is why it's important to continue to segregate out the recycling things. We dealt with this, we've had some that come in, Dan's correct, our current contract language, when that is no longer multi-source recycling, it gets mixed, they consider it contaminated. Per their contract, any contaminated loads can be billed at $95 per ton to dispose of. So currently, our bottles and cans is roughly $30 a ton to get rid of. So we met with the hauler and the facility that we bring our recycling to, negotiated a single stream price, which is in line with other municipalities of what they're currently paying to dispose of single stream. So it's really just to have though we're trying to do some things internally and through, plus informing the public to be diligent in, separating the recyclables. We just want to have a mechanism in there so we're not getting hit with the full contamination charge.
Right. Charlie?
I happened to talk to one of the haulers, not the current hauler, and he said most towns are on single stream. And so are we, say, unique in being separated like this, or?
We are. I don't know the exact percentage of municipalities in Connecticut have made the switch to single stream, but it's probably 85–90%. So we are fairly unique in the fact that we still segregate into multiple streams. I think it's a very good thing that we've managed to maintain the multi-stream, because all the paper and whatnot that we do keep segregated, we still collect revenue for. Versus if we just piled all of our recycling together in one, we'd pay this $75 a ton for all of our recycling. That's the current market rate. But Jamie is, thank you for bringing it up. Any contamination that isn't, part of isn't clean recycling, when we reach the threshold of 5% contamination in any of our recycling streams, we get billed at a rate of $95 a ton. So it's very imperative that the residents at the curbside keep the proper materials in the proper streams and don't add things that don't belong there.
In other words, so if we could keep the multiple stream kind of pure, right, then we'd be better off than 98% of all the other towns.
Correct. The downside of it is by having to do a manual collection and keep those in separate streams, there's a hauling surcharge to it, the collection surcharge, but I think it pays for itself rather than spending $75 to get rid of all of our recycling per ton.
Okay, other questions?
Yeah, Joe, just, so Dan, how do we, on the recourse side, how do we go back to them? Because obviously, that's contaminated, it got picked up, February 1st, you're not delivering it until, February 20th.
Well, we know at the transfer station when a load gets mixed, if there's a truck failure or there was a collection failure. So we know at that point in time that the truck comes to the facility that there's a, there needs to be a fine levied on the hauler.
Okay, and then how do we collect that fine? We notify them?
We deduct it from their monthly payment.
Okay.
I got one more.
Charlie?
Hey, Dan, on this Murphy Road recycling letter, it shows the $75 per ton cost for the town, and then another line, $75 per ton minimum. Now, is there a meaning to this minimum that's not in the first line?
It's a good question. I think that comes from the original language in the bid response sheet. Because oftentimes, in previous years, before the market collapsed on us, it was a revenue stream, and so that would be based on maybe the market or something, so there might be, they pay us $30, but minimum $5 if the market collapsed.
All right, so you don't see any difference between those two?
No, it's just, yeah, I think it's just vestige from the
right.
bid response sheet.
Thank you.
Okay. No other questions? Somebody want to move this?
I'll move it, Joe.
I second it.
Been moved and seconded. Discussion? All in favor?
Aye.
Thanks,
Thank you
Dan.
very much.
Next is back to number 8, which is to consider and approve adjusting the Human Resource Director's salary for fiscal 2019 as per resolution approved by the Board of Finance on November 26, 2018. And that would be in the minutes, right?
Well, it was in November.
November meeting,
It's
yeah.
November 29th, so.
Jamie, you want to present this?
Sure. So, yes, I came before the board in November, discussed a little bit about what we were going through with the Human Resources Department as far as evaluating the department. I had a third-party outside consultant come in, evaluate the processes, the functions, look at the job descriptions. We were in the process of recruiting a director for that position. I would just say, in the current budget, there is a director, assistant director, a payroll coordinator position, as well as there was a part-time risk management position. That's under the current 2019 budget. I had wanted to have some ability to really go out there and recruit a director and have some flexibility in those job descriptions, and with that, the salary. So without exceeding the overall budget. So we do, like I said, we went out to recruit. We have now brought in a full-time director, evaluating, like I said, the department, speaking with the new director. We do feel that we will need a part-time risk manager. The director will assume that role. So that's why before you tonight, I'm looking to make an adjustment. The current position is budgeted at $84,050, with the part-time position at $25,350. So I'd like to increase the director position to $103,000. I think it's also important to note that the position was, we had requested at $104,000 2 fiscal years ago, which during this budget, this body approved. However, during the budget process, it had been reduced further. And so I think the salary of $103,000 is certainly in range, is it within the market, is a fair salary. I'm certainly looking in comparison to other municipalities comparable to Branford. It is certainly within the range, if not maybe even a little bit lower.
So ordinarily, the board does not adjust salaries or necessarily on a regular basis throughout the fiscal year, usually wait for the budget process. But I think in this instance, again, working with Jamie and coming before us in November. I think it's appropriate that we consider this. Questions from Jamie on this?
This is all funded internally within the budget.
Yeah.
Yes, right.
I don't see any big change here, Jamie. I mean, you're taking from part-time and just giving it to the full-time. Who's going to assume that same workload?
Correct, yes.
So somebody want to move this?
I'll move it.
I'll second.
I'm sorry about that.
Go ahead.
Moved by Charlie, seconded by Victor. Additional discussion, questions? All in favor?
Aye.
Very good.
Thank you.
Yes, this would be an agenda for you, yes. Yes.
There's no transfer required, there's, due to the vacancy within the accounts, that there's, but however, I welcome to go to the RTM for discussion and approval of the thing, but there won't be a transfer.
Okay, with no other business to come before our board, I will entertain a motion to adjourn.
So move.
Take it back.
Then moved and seconded.
This program was
All in
brought to you
favor?
in part
Aye.
through the support of the Town of Branford. Watch town meetings and other videos on demand at BranfordTV.org.